Welcome to It's No Secret, a podcast for those who want their money questions answered.
Join us as we talk to real Kiwis and share truths about our own financial lives, because the truth is, there is no secret to achieving financial freedom.
Hello and welcome to It's No Secret. Today, Kat and I will be chatting about diversification. Now, diversification is a very important concept and applies across all asset types, property, shares, everything, essentially your total portfolio. And yeah, we really just want to take it back to basics today to understand what diversification is, why it matters, and what the types of diversifications are.
When you said diversification is a concept that applies across all, I thought you were going to say all parts of your life.
I mean, yeah, that's
like,
true actually.
Does it?
Yeah.
Your partner?
Oh yeah, maybe not your marriage, no.
I was like, where's she going with this?
You probably diversify your feelings, I don't know, throughout the day.
True. Maybe your friendship group.
True, actually, yeah.
So we're talking about investments, I guess, and
Just
money
to
today,
clarify.
but perhaps these lessons could expand further afield.
Yeah. Yes.
Cool. Okay, what was my first question?
So the first question is, what is diversification at a high level and why does it matter?
Question. So I've just actually referred to the internet to help me answer this, because if you Google like what is diversification, you go onto Investopedia, it gives you this horrendously boring explanation. So diversification is a risk management strategy that creates a mix of various investments within a portfolio. A diversified portfolio contains a mix of distinct asset types and investment vehicles in an attempt to limit exposure to any single asset or risk.
Sounds horrific.
Right? I feel like there's a lot of buzzwords in there. Also, people don't like the word exposure, which is really hard because when you're talking about diversification and you come from financial services, you often start saying exposure. And I feel like for the layman, regular person, that doesn't really mean anything.
No.
So we're going to try and take it back to, I guess, real people language. What is diversification? It's basically, in its most simplest form, having more than one thing.
Okay, yep.
Right? So if we think about it from a point of view of a investment, not being diversified would be owning one house in one street, in one suburb, in one city, in a country, right? And having all of your money in that one asset class. That is literally the opposite of diversification.
Yeah.
Whereas diversification, if we take the property example, would be owning, say, 20 properties in 20 different streets in different parts of New Zealand and in completely different areas. That would be what's called like diversified in the property market.
Yeah.
Now, when it comes to diversification between different asset classes, leading on that example, we can see that it's really easy to do that in some ways and it's quite hard to do that in others because the transaction costs, the amount of money required for you to be diversified would then vary. And there's also a little bit of, not so much debate, but I guess general ethos around how many different things you need to own in an asset class to actually be diversified.
That's a perfect segue. So like,
Do you know what the answer is to that?
well, in relation to stocks,
Yeah,
maybe. I would say data shows that between 20 to 100 stocks is actually well diversified, but that's a point of contention potentially for a lot of people that think that they need thousands and thousands of stocks to feel or to be diversified. But also there's different types of diversification within stocks in terms of sectors, location,
industries, all that kind of stuff.
Yeah,
absolutely. And I guess the real reason like we want to be diversified is as per the Investopedia definition, which is that you're just trying to limit your risk. So the reason why people talk about diversification when it comes to an investment strategy is that they naturally want to reduce their risk because everybody is a human and wants to earn the most amount of money or grow their money in like the largest possible way with the least amount of risk. And in order to do that, you need to have some diversification. So pots of money across a number of different assets or a number of different things rather than just one pot of money in one thing.
Yeah.
Because that's quite risky.
Yeah, definitely. I feel like the perfect example of this is a house.
Yeah.
And that, a lot of people think, let's go all in on the house. And even though we're not even going to talk about the fact that it might be a lifestyle asset versus a growth one.
Yes.
But, to your point also earlier, it's very hard to be well diversified with property because the barrier to entry is so high.
Yeah.
And then to get 10 properties in 10 different locations feels like quite a barrier versus, let's say, buying into a fund.
Yeah, exactly. And I think like it's one of those things that we as a regular investor, need to factor in what type of asset class requires like what level of diversification, because we don't want to overcook it, right? If we just blanketly said you need to be well diversified across every single asset class, does that mean you're going to every single major bank and opening a bank account with them and splitting all your cash across those banks? Not
Probably
really.
not. Yeah.
No. Like, if anything, that potentially poses more risk just from administration or like burden or making a mistake or forgetting money is over here or whatever that might be. It almost starts to have more potential problems than benefits. So you don't want to apply the same rules around diversification to, say, cash or term deposits in the same way that you would investing in the stock market or investing in property as a property investor.
Yeah, nice. On that, what would you say to, maybe some people think that there's this type of diversification outside of like holding all your money with one platform, for example.
Yep.
So let's say, like in the instance of Kernel, we offer KiwiSaver funds and savings accounts. If I have all of my money, if I have my KiwiSaver and I've got funds and I've got savings with Kernel, is that like a risk?
Great question. So I think that definitely comes back to like people associating diversification with reducing risk. And so you need to then think about, well, what type of risk am I trying to address here with the thing that I'm doing? So for pure diversification strategies that we've talked about, the primary risk that you're trying to reduce is having too much money associated with the outcome of one type of investment. So let's talk about that in terms of like if we're investing in the New Zealand stock market and we invest all of our savings into two companies, we are solely reliant on those two companies being successful in order for that money to grow. Now, if we were diversified across, say, a top 20 fund and we had our money invested across all of the top 20 companies, we're only really reliant on a handful of those top 20 companies doing well, and we have a much greater chance that the money will grow because you have a spread of investments across a range of different companies, right? So if two of them were to blow up, let's say the two original ones that the first person chose, it probably won't impact their long-term outcome, right? Now, if you take that same philosophy to investment platforms or to banks, what you're really trying to address there is a different type of risk, because the investment platform itself is not going to enable the success of your growing assets. Does that make sense?
Yep.
Like the investment platform or the KiwiSaver provider is ultimately just providing you access to the underlying investments that you're choosing. So really the success in terms of growing your money and therefore what type of risk you need to adjust based on diversification still comes back to the underlying investments.
Yeah.
Yeah?
Yeah. But in some ways the like underlying investments isn't synonymous or like separate, I guess, to the provider, because they'll have like Kernel funds, right?
Yep.
It's like, but that's a different choice in terms of the like risk. Do you know what I mean?
Yes. Expand more on that.
So like if let's say that the S&P 500, for example, Kernel offers that fund. Now you can also get it through other providers. Like I'm choosing that underlying fund.
Yes.
Like regardless of the
platform.
Yeah.
Exactly.
But then there's also some instances where, like some funds might be exclusively Kernel versus another one. So you are making the choice to go to that place for that fund. That's a different choice to like a risk related one of keeping your money all in one place.
I see what you mean, but it's also not, because let's say like Milford's funds, right? An active manager is a great example because active managers will all be running their own strategies. Yep. So even though the underlying investments are potentially invested in the same companies, the funds are generally proprietary to them, i.e. Milford's active growth fund is their own active growth strategy. So if you wanted to access that, you predominantly are going direct through Milford, right?
Yep.
Now, in terms of then like risk with the success of that investment and diversification, you're making two bets. You're betting on Milford being a great active manager, which is kind of a separate conversation.
Yeah.
But then you're also making a bet on how many underlying companies or investments are in that fund. And ultimately you're needing those underlying investments to succeed. In the event that Milford, as the fund manager, were to fail, that wouldn't impact, under the regulations and legal structures in New Zealand, your success of the underlying investments.
Yeah.
So then when you come back to like, what's my risk of going through a fund manager for a specific fund, whether it be proprietary or general, we could say like a general one is your S&P 500 example, because you could access that through, 3 different fund managers in New Zealand and like 3 other platforms.
Yeah.
If you are assessing the risk of the fund manager or the platform, there are protections around your investment that essentially remove that company's risk of failure from a risk that you would endure as the investor.
Yeah.
Does that make sense?
Yeah.
So that's kind of like a long and a short way of saying,
It's separate but not.
well, you don't need to worry how much money you have with one individual provider, as long as the provider that you're choosing is appropriately licensed and vetted and checked by the Financial Markets Authority in New Zealand.
Yeah.
Yeah. And if there are protections around that, and we've talked we've talked a little bit about this before, where there's a difference between, a retail offering and a wholesale offering, and people really need to look for retail offerings because you do therefore have those baked in investor protections. If you have those, what happens to the actual fund manager itself or the investment platform is somewhat irrelevant to your risk.
Yeah.
I think as well, people like perhaps get a little bit more nervous about this with investment platforms because they're newer, but you can apply the same kind of logic to the bank, right?
Yeah.
Most people, and I'm going to say most because there are absolutely some nuances who are a little bit doomsday about like banks, but most people don't fret about having all of their mortgage, all of their savings, all of their pay predominantly coming into one bank.
That's very true.
Right?
Yeah.
If you think about the amount of money over your lifetime that's going through one bank account or one banking provider compared with the amount of money that you're accumulating from that larger pool with one investment platform or one, fund manager, it's actually like disproportionate. The bank has much more requirements around keeping those funds secured, as it should, but we also have very strict requirements to reduce risk to a consumer as a platform or a fund manager.
Yeah, cool. And the requirements for that also vary on the investment structure, right? In terms of KiwiSaver versus funds versus savings, like different protections in place.
Absolutely.
Yeah.
And so, you can play out the scenario of like, let's say someone's like, okay, Kat, I don't believe you. I still feel like I need to diversify across providers. But playing that out, what you're doing is, let's say you have decided to invest in the S&P 500. You're opening 3 different accounts, one with Kernel, one Invest Now, perhaps one with Sharesies, and you're then accessing the same underlying fund or generally the same underlying fund and the same underlying companies through 3 different mechanisms that will each have 3 different pricing points that potentially might be in New Zealand dollars versus US dollars and the complexity of that. And I just kind of look at that like, why?
Yeah, it sounds like a lot of admin.
Unless you're really truly stressed out about it, that does sound like a lot of admin. And the other thing that a lot of potentially retail investors don't want to hear is like, I know that say $50,000 savings it can be a significant and meaningful amount of money to people, but when we're thinking about some of these providers, you have to think about the other investors, like the wholesale level, institutional level investors that may also be investing singularly in one provider. You could have like another investor and say one of the Kernel funds at an institutional level that's investing over $100 million.
Yeah.
Yeah. They're not wanting to spread that $100 million across 3 different providers to access the same fund because it doesn't actually make a lot of sense.
Yeah. Yeah, cool.
I feel like we've diverged, but here we are.
Right. We can bring it back.
Diversification and security.
We're diversifying the chat.
Exactly. They're intertwined. So that's
good.
this part of diversification that you shouldn't get hung up on.
I think it's an interesting conversation at the same time because I think it's one of these things that it's very easy to grasp onto thinking that you need to quote unquote diversify in that way, but really like, do you need to? Yeah. But yeah. Anyway, so what does great diversification look like in terms of stocks? So we've briefly touched on it with property, like how diversified do I really need to be?
For sure. Well, I think you kind of hit the nail on the head at the start, right? Where the general consensus is that as long as you have somewhere over about 20 companies, you actually start to reach the threshold of being well diversified. So there is a little bit of a perpetuated myth, I think, particularly in the world of index investing, where you need to own every single company. Like diversification means having every single company around the world.
Yeah.
And You could do that if you want. There are funds out there that offer that kind of thing, and you're going to have in the realm of like 8,000 companies. But the reality is that because most of those funds are what's called market cap indexes, so they're weighted in proportion based on the company's size, the returns that are contributed from the larger companies to the overall pot are much, much greater than those at the smaller end. So the impact that the companies from, say, let's say we have the pool of 8,000, the impact of the companies that are from, I'll be generous and say 300 through to 8,000 is actually very minimal, almost negligible on the total impact around diversification and performance, and therefore reducing risk of the return on that total fund. Yeah. So we're pretty big fans at Kernel of talking about diversification being important across sectors and markets, i.e., not just being focused on like the S&P 500 US market, also having exposure or investment in companies that are more globally diversified. So, we hear a lot about the S&P 500, but also Europe does exist. Like there are some other continents that really great, big companies are based out of. And so understanding that we have some country diversification is important because different countries' economies will perform differently at various times. And then also understanding that sector diversification is important. And I'm going to ask you a question, Christine. Can you explain what sectors are?
Another word that I would use for it is industries. So I think of things like healthcare or utilities or consumer staples, like those types of things. So
Technology.
Exactly. Like you don't want to go, not advice, all in on tech, right? We've seen this with the, it can swing both ways. You need to be across multiple sectors.
Yeah. Do you know generally why we would say that's important?
Probably in the similar vein that different markets perform in different ways. It's the same thing with different sectors, like infrastructure, for example, is a tried and true versus like tech, which can be quite volatile.
Yes.
Is that it?
Yeah, that's exactly right. So, the good thing about, I guess, focusing on sector diversification, and you can also, you're right, think about sectors as like a type of industry. If you think about utilities as a sector, they are things that essentially we humans need all the time. And sure, they're going to change in terms of what like the providers within the utility space look like over the next 20 years, but that's a pretty core type of, I guess, requirement and therefore company. And so they are going to have as a sector a different return profile and volatility profile than, say, your consumables or your technology, which has totally different factors at play that basically impact, their returns and their volatility. So the idea behind sector diversification is that each sector will have ups and downs at different times. We also tend to see that in market declines, they act differently. So, one nuance to that was COVID basically saw every single sector decline, even those that would typically remain pretty stable or potentially have a bit of a boost during a downturn. And that was kind of, I guess, representative of the fact that it's like a black swan event and it's a total unknown for the modern world. And there was a ton of uncertainty. But in a typical market cycle, when there's a downturn, you would see that there are some sectors like utilities, infrastructure, that remain pretty stable, even when other things like consumer goods or technology might be much more volatile.
Kernel, shout out to Kernel, also did some great research on equities versus infrastructure versus property.
Okay, love that.
In terms of like looking at the different asset classes in terms of diversifying across that in a total portfolio. So we can link that in the show notes as well. But that made me think of that, as you were saying, in terms of industries as well.
And I think, you mentioning property is an important one because a lot of people think that like property means I just have to actually buy a house, but they tend to forget that there are often listed property companies that provide overall investment or the ability to be invested in the property industry, sometimes residential, mostly commercial, but they will typically move in the same kind of cyclical way as like the residential property cycle, right? So you don't have to be a property investor personally in terms of buying an individual investment property in order to also have some investment in the property sector. You can get that through a listed like
commercial
property fund,
yeah.
or if it's a like broad market, like a Global 100 or an NZ50, you're likely to have some listed property companies in there.
Yeah, nice. Love it.
Yeah.
Great. Okay, so this one I feel like is pretty relevant for probably a lot of the listeners.
Yes.
And we touched on it briefly, but if I went all in on my house or property, am I in trouble? Like, what do I do to get more diversification?
Question, but I'm going to just answer it with a question. What do you mean by all in?
So let's say I've built up my deposit. I've taken my KiwiSaver out.
Yep.
All my cash savings.
All my savings.
Yep.
Okay.
So all my money is like in there, and you know, potentially every paycheck I don't really have any savings leftovers. Maybe I've got a small emergency fund, and I'm maybe like, oh my gosh, what if the property market moves? I'm losing like heaps of equity.
This is a great question. I love this.
Am I
really
projecting?
setting me up here.
I don't even have a house, and I'm like,
So I think this is firstly a very common scenario for people when they get onto the property ladder for the first time. So I don't want people to necessarily feel bad with that, but it is a really interesting one because a lot of people feel like that's not risky, right? But when you're looking at that scenario that you just explained to me in the concept of diversification and what happens to your overall balance sheet and wealth based on a residential property market decline or something happening in your particular suburb or your city or wherever it may be, you are at risk.
Yeah.
There's kind of no two ways about it, right? And so this is part of why I think, you know, we've talked a lot before about why we don't buy into the philosophy of just buying a house and focusing on solely repaying your mortgage. And once your mortgage is repaid, then looking to invest. And there's a couple of other reasons for that as well. But one of them is exactly what you've just touched on, because if, you know, it takes, I'm going to guess most people that are buying a home at least 20 years to pay that off. That's a really, really long time to only have your returns and your growth of your overall balance sheet coming from one asset. Yeah. And one asset that we know will actually perform differently to everything else. So sometimes that asset class will do great. Other times it will not. And that's where I think, you know, it is really helpful that when you can, getting back into making sure we're contributing to KiwiSaver, rebuilding that towards retirement, and then also thinking about obviously covering your minimum mortgage repayments and making sure you're comfortable with any debt repayments. But then beyond that, genuinely thinking about, well, can I start to also invest outside of just my home loan?
Yeah. It's also very illiquid. So if you were to have something happen in your life, you can't sell your bathroom, right? To then pay for that thing. Whereas that is a benefit of something in the share markets that ultimately, regardless of what the value is done, you can sell it out at a way faster time frame than
exactly.
property.
You can have money easily within a week.
Yeah.
Whereas, you obviously can't do that with your house. And equally, we kind of see the behavior of like most people don't want to sell their house for less than what they bought it for.
Yeah,
so
true.
They tend to hold on or live through things, potentially for better or worse, right?
What would you say to someone who's thinking, yeah, but I'm going to diversify by leveraging my property and getting another one? Instead of, do you know what I mean?
I do know what you mean. I would say you've diversified outside of potentially your own suburb and maybe, if you try really hard, your own city, although I'm looking at you because I'm like, you and I both know someone that didn't even recently diversify out of their own suburb.
Yeah, exactly.
But you also haven't diversified out of your asset class. Yeah. You're still in residential property and that's all you're in, right? And I think the last couple of years is a really good example of showing people like why that is risky or why that's not a foolproof answer. And I think also the residential property asset class as a general investment is going to be a really interesting one because there are a ton of things impacting house prices that are entirely outside of our control. Hello, environmental effects, and various weather events. And that's something that's quite unique to property. It does also obviously impact companies, but the thing with investing in the share market, even if let's say you just absolutely love property and we somehow manage to convince you to not buy an investment property and invest in something and you just buy a commercial like real estate fund, you've still got potentially hundreds of companies or 20 companies, you know, that then have lots of different investments across different parts of New Zealand and the globe, right? So I think that, I would just implore young people that are buying into the philosophy of only investing in property to really think about what are the ultimate risks associated with that.
Yeah. And also, like, how much risk are you willing to take, and do you feel comfortable with? Because to your point, as you're saying the thing about commercial property as well, I was thinking you also have to get tenants. Like, that's a very unknown variable. You know, like, there's a lot that can impact that. Whereas you don't have to put tenants in your fund, do you?
No, you don't. You don't.
Obviously biased over here, but that's all right. Cool. So to round out, any other tidbits about diversification that you want to share with the listeners?
Yeah, so I think one thing that we've talked a little bit about recently with some financial wellbeing seminars we've presented, and we'll link to it in the show notes, but there's a really, really good little graph that basically just shows over the period of 2002 to 2021, every single developed market return on a yearly basis, and they're ranked from lowest return to highest return, right? So they've taken, the New Zealand market, Norway, there's Germany, there's Ireland, like every developed market, right, as a country. And they've ranked them from lowest to highest over those, whatever that is, kind of 16 odd years, right? Mm-hmm. And it's a really like visual little square. And the point is that, so each country has obviously been given a colour.
Yep.
And the point is that the whole square in total is just a mishmash of colours.
Yep.
Because over every single year, each country has performed differently. And I think that that's an important lesson that we've just been talking about in terms of diversification. Mm-hmm. But the add-on to that is that over that period of time, so 2002 to 2021, the New Zealand market was actually the top performer twice out of all developed markets, right? And so one thing that we often hear about when people are debating not only which fund or, ETF or company to invest in, and therefore like how much diversification they should have, they start to buy into the whole like, I don't want to invest in New Zealand because we're only 2% of the global economy and this and this and that and down on New Zealand and blah, blah, blah.
Yeah.
But what I would say, based on this data, is that New Zealand as an economy can be a real top performer. And just because we have a small size or other markets have a much larger size doesn't guarantee that they're going to have success, right?
Yeah.
And it comes back exactly to the conversation we had around sectors and to the conversation around diversification within different countries and what's going on with that country's economy, right?
Yeah.
So don't think that diversification means you need to own everything. Also, don't think that diversification means you need to only own things within New Zealand. It's finding a balance, but don't discount your own home country because we're pretty awesome.
And there can also be tax benefits to investing in New Zealand too.
That's like an added bonus.
Right? Yeah.
I'd actually say that's a real primary
like
driver. But I mean, look, we're talking about diversification here. So.
Sorry, I'll stop going off tangent.
No, this is good. So I think that's a nice visual to kind of show people. Also because when looking at this, I'm like, this is the funny thing. So 2 years New Zealand was the top performer. Then there were 4 years where we were ranked second.
It's pretty good. It's kind of like sport, right? When the All Blacks win.
I know. So, and then out of that whole time period, there were only 2 years where we were the lowest performing market. So, don't discount little old NZ that sometimes gets forgotten off the map. But here we are.
We make it into returns, clearly.
Exactly.
Oh, love it. Cool. Well, thank you so much for sharing your tidbits. Love this diversification chat, as always.
I didn't think it was just going to be too exciting, but here we are. We still managed to talk for a long time.
Very passionate. Cool. So big thanks to Kernel for enabling us to do what we do. Don't forget to hit like and subscribe wherever you're tuning in, whether that's video on YouTube or listening on Spotify or Apple Podcasts. If you have questions, feel free to get in touch at It's No Secret on Instagram, send us episode requests, feedback and more. And until next week, we will say see you later. Thanks for listening.